The $12 trillion time bomb, 1,000 words approximate. The financial world is quietly shaking, and most Americans have no idea why. But behind the headlines, behind Wall Street's calm smile, and behind the Federal Reserve's careful language, a $12 trillion monster is now starting to break loose. This monster is called the leveraged loan market, and its cracks are spreading faster than any economist predicted. For years, lenders stuffed the American financial system with loans given to companies already drowning in debt. These weren't high-quality, stable companies. These were corporations that couldn't survive without constant new borrowing. Companies with weak cash flow, declining revenue, and credit ratings so low that even banks refused to touch them. And still, Wall Street kept lending. Why? Because the system was built on one deadly assumption: interest rates will stay low forever. That single belief transformed an already risky lending space into a massive $12 trillion pile of unstable loans held by pension funds, insurance companies, high-yield investors, and even everyday Americans who have no idea their savings are indirectly tied to it. But then, in 2022, 2023, and 2024, everything changed. The Federal Reserve launched the fastest interest rate hike cycle in 40 years. Suddenly, these companies that were barely surviving at low interest rates were now paying 5%, 6%, 8%, even 12% on their debt. Many simply couldn't afford it. And the dominoes began to fall. Leveraged loan defaults, once a rare event, have surged to the highest levels since the 2008 financial crisis. Companies that looked alive on paper are now collapsing under the weight of borrowing costs they never expected. Restaurants, retailers, tech startups, manufacturing firms, transportation companies, all being crushed by their own debt. But this isn't the whole story. Because unlike 2008, this crisis isn't happening inside the banking system. Banks learned their lesson. They pushed these risky loans into the shadows, into private funds, CLOs, shadow banks, overseas investors, investment vehicles no ordinary American understands. Today, over 75% of all leveraged loans in the U.S. are held outside the regulated banking sector. That means when defaults explode, nobody knows who ultimately eats the losses. This is what financial regulators fear the most: a slow-motion disaster happening in private markets, hidden from the public, until it suddenly spills over into the broader economy. And this isn't just about corporations. When companies default, it affects workers who lose their jobs, investors who lose retirement money, bondholders who lose interest payments, suppliers who lose contracts, banks that lose loan fees. Entire towns built around those companies. A single leveraged loan default doesn't just hit one company. It hits the entire ecosystem around it. But here's the real danger. Many of these loans were given with almost no protection. Wall Street called them covenant-light loans. That means no strong collateral, no strict financial requirements, no legal safety nets, no meaningful investor protections. Essentially, borrowers were allowed to do almost anything, even as their finances deteriorated. Investors weren't just buying risky loans. They were buying risky loans with zero guardrails. And now the consequences are exploding. What makes this crisis different from 2008 is its fragmentation. There's no single Lehman Brothers to point to. No one big villain holding the entire bag. Instead, the risk is spread across thousands of institutions: pension plans, corporate treasuries, private funds, global investors, all exposed without realizing how interconnected the danger truly is. And as defaults rise, one question is now echoing across Wall Street: what happens when the weakest links in the American economy finally break? Because they are breaking. And the next stage of this crisis will be far more painful, not just for investors, but for the entire U.S. economy. The domino effect begins. The leveraged loan crisis is no longer theoretical. It's real, it's accelerating, and it's beginning to spill into the broader American economy. What started as quiet cracks in corporate balance sheets is now transforming into a fast-moving chain reaction, the kind that destroys companies, jobs, and financial markets. In the last year alone, default rates on leveraged loans have more than doubled. Bankruptcies among heavily indebted companies have surged to levels not seen since the Great Recession. And credit rating agencies are warning that more than 40% of all B-rated companies are at risk of distress if borrowing costs remain this high. This is the first major impact: corporate layoffs. When a company's debt payments rise faster than its revenue, the quickest way to cut costs is simple: fire people. Industries across America, manufacturing, media, healthcare, energy services, retail, are already reducing staff because their debt is eating every dollar of profit. Millions of American workers don't realize the real reason they being laid off isn't automation, or restructuring, or digital efficiency. It's debt, corporate debt, and the cost of money that suddenly became too expensive to borrow. The next major impact is one the public rarely sees coming: the collapse of zombie companies. Zombie companies are businesses that survive only by refinancing their debt. They don't make enough profit to cover expenses. They don't grow. They don't innovate. They simply exist because borrowing has been cheap for so long. But now, high interest rates are killing them off at historic speed. Every zombie company that dies sends shockwaves through employees, landlords, vendors, lenders, municipal tax bases. It's not just one company going bankrupt. It's an entire community losing its economic engine. But this is just one layer of the crisis. The deeper problem is the giant financial structure built on top of these loans: CLOs, collateralized loan obligations. CLOs are like the mortgage bonds that collapsed in 2008, but instead of being backed by home loans, they're backed by risky corporate debt. When defaults rise, the weakest layers of these CLOs absorb losses first. And guess who owns those layers? Insurance companies, pension funds, investment funds, university endowments, corporate treasuries. Millions of Americans have retirement money invested in these vehicles without having the slightest idea. If losses accelerate, these funds face a massive challenge. Do they sell? Do they absorb losses? Do they rebalance portfolios? Do they shift to even riskier assets to chase returns? Every decision they make adds instability. But the most dangerous part is yet to come: the liquidity crunch. When companies default, lenders panic. When lenders panic, they stop lending. When lending dries up, even healthy companies struggle to borrow. This creates a credit freeze, the exact kind of environment that leads to recessions. The $12 trillion leveraged loan market isn't just a corner of the financial system. It's the lifeline for thousands of American businesses that rely on loan refinancing to survive. And right now, that lifeline is disappearing. Here's what economists are now warning: business investment will fall, hiring will slow, wage growth will stagnate, borrowing costs will stay high, bankruptcies will accelerate, consumer confidence will weaken, economic growth will shrink, all because the era of cheap debt is over, maybe permanently. The U.S. economy has never been more dependent on borrowing. Every sector, corporate, consumer, government, relies on debt as the foundation of growth. So what happens when that debt becomes too expensive to maintain? We're about to find out. This crisis won't explode overnight. It won't look like 2008. It will be slower, deeper, and more painful, like a financial erosion eating away at the foundations of the economy. One default at a time. One bankruptcy at a time. One lost job at a time. This is the beginning of a new era, the era of the great corporate shakeout. And unless interest rates fall sharply, or the economy grows at an impossible pace, this $12 trillion crisis will continue spreading. Because once leveraged loan defaults begin, they don't stop easily.